Hello everyone, welcome to Emkay Macro and Market Moves. Today we are very pleased to have with us Mr. Nirav Sheth, the CEO of the institutional equities business at Emkay Research. So sir, of course over the last few months, essentially the entirety of this year, we've seen a lot of disruption all over the world, right? And it only seems that that disruption and that volatility is continuing, that there's no end in sight. Wherever you look, China, Europe, UK, even the USA for that matter, there's a lot of volatility in markets and in the overall economy as well. So where do you see all of this sort of not terminating, but where do you see this going in the next 3 to 6 months? What do you think? What is your outlook on the global turmoil that we're seeing?
So, this obviously we've got a fair amount of volatility because of geopolitical situations that you've created, but also because of the fact that there's a big reset that is happening, right? So, you've been used to 10 years of almost negative real rates, and then just in 6 months you got a reset that has you've gone into very high single digits and all. So and in a world that is very highly levered today than what it was a decade back. So it's going to take time. Not that we've got a great view in terms of when the things can normalize, but the way I look at it is that what are the anchor variables that you want to look at. So I think that big issue is obviously the reset and the geopolitical risk. It doesn't seem that that is going to end very quickly, because you've got the war is not going anywhere, and I don't think that there is anything left, or I don't think the West is giving anything to Putin to have an honorable exit, right? So no one of us knows exactly how this is going to end. The second big problem seems to be the fact that China has got its own problems, right? Again, we think that it is cyclical, it could well be structural, right? So you have got 20 years of more than 40% fixed asset intensity, right? And that is largely because you're producing for the world at large. Now that is going to change, right? So that's going to be a big drag on the global growth. So we are a part of that, but that is what the markets are about, that is what the economy is all about. I don't think that in my 30 years of career, you would have had too many time frames where you say that there's no uncertainty. We'll live with that. In next 3 years, in 5 years, in 10 years, markets will tend to grind higher because profits will grind higher. But I think that we are passing through fairly disruptive times. So we need to be very cautious for sure.
Exactly. So having said that, sir, this is obviously something we're looking at on a global scale, as you said. And therefore it obviously feeds through into India, because India is not decoupled. India is a part of the global economy. So again, the same question, but then for India. So if all of this, as you're saying, is going to persist, how do you see Indian sort of markets, or just the economy, or generally even policymakers' hands, where do you see that sort of going again in the next 3 to 6 months?
So first of all, I think what we can do at best is that we can try to relatively do better than the rest of the world. But if the rest of the world gets indexed to 50 from 100, you are also going to get re-indexed. There is no other way. You can't escape, because you are living in a globalized world. I think the channel through which the global turmoil sort of filters into India will essentially happen through the interest rates and then through the foreign exchange. So it has to be through the balance of payments, so as to say. And to me, that is the biggest risk factor that we are sitting on right now. So just think of it. If you think that, so my personal view has been that we are fairly okay in terms of how the economy is shaping up. We are doing reasonably well in terms of the consumption, in terms of the investment cycle. And I think if my monetary policy remains conducive to that, if I don't have to act based on what is happening in other parts of the world, then I'll be able to sort of glide through this without any pain. If we need to defend our currency for whatever reasons, then we'll start choking the growth rate. And to me, there's a big risk, because India sort of stands out because of the growth. And if you start killing the growth, then we'll play a very big catch up on the reverse side. And that to me is the biggest risk. And frankly, I don't have an answer in terms of how to try and avoid that. You cross the bridge when you come near that. You can't prepare for that.
So that's actually an interesting point you raised, sir, because as you said, India has outperformed relatively for the majority of this year. do you think there is any downside to that, in the sense that do you think there is any risk, or is there something that could hurt us further down the line, because we've outperformed so early in the cycle that when the actual pain comes in, like for example, there are predictions of recessions hitting the US, Europe and China in the next 6 months to a year. So do you think that because we've outperformed so early that the sort of come down could be even steeper because of that in the time to come?
Oh, 110%. So because the markets are by and large reflexive. So the way things work is that if you actually think that there's going to be a pivot at any point of time where there is one more stage of risk of assets, then you will sell what you can sell, what is liquid, right? And India actually stands out, right? So one of the things that obviously your markets have become very liquid because you've got $30 billion of selling and you've got absorbing capacity in the domestic market. And that carries a big risk because the invested amount in India is about $150 billion, but mark to market, the FI holding in equity is about $500 billion. So just think of it, that if you want to try and sell this off, let's say you want to just reduce the percentage by 1/10 and you have a $50 billion of selling in a quarter, that can create havoc. This is exactly what I was referring to when I get worried. So about how these global things tend to filter into Indian economy. You can't necessarily absorb $30-40 billion of selling in a quarter with oil at $80-85. It can create havoc on your rupee, and then RBI needs to defend it with interest rates, and when you start doing that, you will reset your expectation for the growth rates, so that could lead to one more round of selling, right? So that is how you get into that very, very vicious circle. You got good forex reserves, but like I said, when you change your expectations of the growth rate, everything changes, right? So that to me right now is the biggest risk point. So if you have got one more reset of US rates going up, let's say you got a level of dot rate for the Fed plot, right? And if there is one more reset that happens over there, maybe we'll just scale it. It's very likely at this point of time.
So then, having said that, moving to the markets a little bit, where should investors in India or looking to invest in India, where should they position themselves from a sectoral point of view? Again, if we look at from a 6-month to maybe even a 1-year long horizon.
Right. So I think that you should try and stick to what you think that you have fair degree of confidence in terms of prediction or your ability to estimate stuff, which at this point of time to me is largely about the domestic cyclical, right? So you got a fair sense of comfort about, for example, how auto companies are going to do, how consumer discretionary is going to do. Banks are holding up pretty well, which obviously sits on the top of what happens in the Indian economy. You don't have any problems about the asset cycle, about the asset risk on the credit side. So I think anything that, if there's, you've got very high exposure to global markets, exports, you'll be very, very cautious about that. Commodities, I think there are just too many variables, right? So we started in a phase where we are bullish on commodities to now we are bearish on commodities, and I still believe it's very, very difficult to take that call. So stick to the domestic cyclicals. That story seems to be relatively okay. But then you change your view if you get incoming data point that forces you to think the other way.
Sure, sir. Thank you so much everyone for watching, and thank you so much, sir, for being here with us.
Thank you, my pleasure.